Elon Musk overestimates himself, but he is very talented. He's overestimating somebody who doesn't need to overestimate to be very talented.
Elon he's a brilliant guy.
He would not have achieved what he has in life if he hadn't tried for unreasonably extreme objectives. He likes taking on the impossible job and doing it. We're different. Warren and I are looking for the easy job that we can identify.
Yeah, but we don't want to compete with Elon in a lot of things. I mean,
we don't want that much failure.
Yeah.
Welcome to Personal Finance Cat, where I share my personal take on personal finance. Hey everyone, today I'm going to do something a little bit different from usual. I'm going to analyze the stock of Tesla. A couple of weeks ago, I posted this short on my YouTube channel about Tesla stocks and why I'm not an investor. It sparked quite a bit of interest, mostly negative. In particular, this one comment really gave me a good laugh. You can see it right here. I think it behooves me to explain a little bit more why I'm not an investor. Yes, it's easy to say that it's capital intensive. It hasn't had a track record of profitability, but I did admit that I don't know too much about the company. And that's why I'm embarking on this journey to learn a little bit more of the company, both from a qualitative perspective and from a quantitative perspective, which I'm going to go through in this video. I did listen to the latest quarterly earnings call. It's pretty interesting, I would say, because he's really talking about how he's trying to help the whole world by producing products that are much more energy efficient, which is a very applaudable goal. Don't get me wrong, I have no problem with Elon Musk as a person, an entrepreneur, a tech genius, or the company as a whole in its mission and what it has already achieved. But from an investor perspective, is it a company that supports how I would make the decision to invest or not? Is a completely different question. Like I said, I'm going to go over some of the considerations I would have taken into account in order to determine whether or not I'm going to invest. So let's dive right in. So Tesla has this business of EVs, which is well known. So I have been reading an autobiography of Elon Musk. He has an amazing story growing up and coming to the United States, which had been his dream for the longest time. He was actually a physics major, and he, even back in college, was already very into using energy in a more green fashion. I believe his undergrad thesis was on this topic, particularly solar energy. So this has been his passion. He did start up a few companies that are not necessarily related to this, like his first company, Zip2, and his second company, X.com. They were both internet companies trying to take advantage of the internet businesses at the time. But his ultimate passion is sustainable energy. So this really ties well into his upbringing and his early passion, which makes a lot of sense. But anyways, looking at the 10K, their businesses are not just automotives. It includes energy storage products and solar energy offerings as well, which are the energy generation and storage segment. And they also have other technologies that power the automotives, but potentially can be used for other aspects, such as the battery and powertrain, vehicle control and information software, self-driving development, and artificial intelligence. So these businesses are very adjacent to the EV business, but they can potentially be a lot more. I've heard that they might even license their intellectual property to other companies. Definitely Tesla is a lot more than just an EV company at this point. I've heard people say that they invest in Tesla not because of EV in particular, but because of this holistic energy business, essentially, which is very critical, especially in today's environment where climate change is a real threat to humanity. But anyway, so that's the qualitative side of the business. Again, don't get me wrong, it's very promising. I think he's trying to do great work for humanity as a whole, which is very applaudable. But let's switch gears and look at the quantitative side of the business. Okay, so I got this template from another YouTuber, Matt Heron. He's very gracious in sharing this spreadsheet on his Patreon website. I will link the website below. I did modify the spreadsheet quite a bit, but I think the first page you see here comes from him pretty much. I changed some things around. You can just put in the ticker symbol and it will generate a bunch of information for you. And as you can see, as of today, which is November 21st, the stock price is $235, which is pretty close to the 52-week high of $299. These are just the short-term trend in the last 2-3 years. There had been a dip at some point, which was probably a great buying opportunity for those of you who are a diehard fan of Tesla as a company. So as you can see, the PE ratio is quite high. But let's dive into some of the valuation methods that I would use typically in analyzing a particular stock. And as you can see, out of the 4 methods, 3 are a sell recommendation and 1 is a watch. So let's go into them one by one. All right, so discounted cash flow, or DCF. This is how I structure the analysis. I would go to microtrends.com. It's a very helpful website that shows you all kinds of financial metrics of a public company. The purpose of this DCF method is basically looking at the return on equity. Equity, if you don't know what it is, basically it's what the shareholder has in the company. So for any company, it can be funded either by equity or by a loan, right? So think about if you buy the stocks of a company, you're essentially an equity owner. But then the company can also go out to the marketplace and borrow loans from banks and such. As a shareholder, as an investor, you will look at how much return the company is generating for the equity you put in the company. This method is inspired by the book Buffettology, written by Mary Buffett and the co-author. So the idea is that you want to calculate the equity per share and then get to the return on equity. So as you can see, for the last 10 years or so, Tesla started generating a profit, aka positive earnings for the shareholders, starting from 2020. So right there, as a value investor, typically that is a no, because you haven't seen consistent track record of profit generation, as I mentioned in the short. But because we know that this company has huge potential, maybe we can play around a little bit. Valuation is not a science, right? It's totally an art. Because based on this, your average return on equity is negative. So you wouldn't be able to get a positive number to project its price 10 years outward. But just to explain this a little bit. So you have the equity per share number from the above exercise. And then what we're trying to do here is to subtract the dividends, because that's the money that you pay back to your shareholders, and you would only retain whatever is left over. But Tesla hasn't been paying dividends, so that's a zero. Anyway, so you would use the average return on equity to project the future earnings per share. It's basically based on what equity you think will be retained year over year, and then multiply that by the projected return on equity. You do that for 10 years, and then based on some assumption of PE ratio, and here I just used the forward-looking PE ratio available on Seeking Alpha. It's a pretty high PE ratio, and this is already a rosy assumption that the PE ratio will stay this high. But for a forward-looking company, let's say that is reasonable. So you'll be able to project the price 10 years outward, assuming a certain return on equity, and then the equity that will be in place 10 years from now, you would get a stock price, and then assuming a 20% return, you basically work backwards to get to the price that you should purchase at today so that you can get a 20% return for the next 10 years. So as you can see, the numbers are wonky because, again, the average return on equity is negative. But let's just play around a little bit and say, why don't we just assume that the average of the last 3 years, when it's positive, what would that look like? It's definitely better. It makes more sense because you will have a growing equity per share, assuming each year you have some retained earning that you can pour it back to the business and then keep building up that equity. Let's translate that to a stock price in 10 years, which is basically the earnings per share multiplied by the PE ratio. Because PE ratio, if you don't know what it is price to earnings. So earnings is exactly the earnings per share, and then the ratio basically means that that's the multiple of the earnings, that translates to the stock price. Based on this set of assumptions, the price in 10 years will be $754. And if you discount it back to today's dollar, because you have a set amount of return in mind, in this case is 20%, that means you buy this stock if it's at $121.85. Okay. It's still not a buy, it's a watch, which basically means you should watch it because there's a chance it might go down by 50%, and then that means you can buy it. So it's still not a buy. I think I've played around with this a little bit more. Only if you change this to the current return on equity, which is probably pretty abnormal and hard to say that it will be sustainable, then it will be a buy. But that's really assuming a lot of rosy assumptions. And one thing about value investors is that you should really be super conservative. And if it still returns as a buy, then you definitely buy. All right, then the next method is the 10 cap method. So this method, along with the next two, payback time and margin of safety, they were inspired by this book called Invested by Daniel Town and Phil Town. Both are value investors, especially Phil Town. He has been in the value investing business for a long time. So the idea of the 10 cap method is basically you look at owner earnings. What owner earnings ultimately is trying to get at is the true cash flow from the business, because accounting and real cash generated from the business are very different, or could be very different. So you want to get to the actual earnings as an owner that is actually meaningful to you. Anyway, these numbers came from the 10K, the same document that I was showing earlier about the qualitative side of the business. So you would look at the net income, which is reported in the income statement, and then you would do a bunch of changes, essentially to get to the actual cash, because depreciation and amortization, even though that is an accounting concept, you have to take into account. It's not actual cash out of the business. So that's one example. The other items all have a similar sort of tone to it. Maintenance capital expenditure, for example, it's a balance sheet item because you have to amortize that over time, but it's a one-time cash investment usually, right? Because think about if you have to build a factory, you have to spend $1 billion, let's say. That $1 billion has to go out of the door right away, even though in your income statement, that's not going to show up right away, at least not all of it. So you add that back. And then the reason why we add back maintenance capital expenditure is because some businesses are very capital intensive. So this kind of expenditure happens all the time. And this is definitely typical of business like Tesla. Each year, they will have all kinds of capital expenditures. 10 cap essentially means you would have 10 times that owner earnings. Let me explain that a little bit better. Each year you earn, in this case, 15 billion of owner earnings. And if you buy it at a price that's 10 times that, then it basically means you have a 10% capitalization rate. So think about, I think real estate is a very good example. So if you buy a house for $100,000 and each year it generates $10,000 of cash flow. And this cash flow is after all expenses such as mortgage, property management, property tax, utilities, etc. So after all that, you are still left with $10,000. Then for the $100,000 of money you put in as an initial investment, the return is 10%, which is 10,000 divided by 100,000. Right, so the numbers here are several magnitudes bigger, but it's the same idea. So if you earn $15 billion per year as your owner earnings, you would expect to pay a price of $151 billion to own this whole company. That will give you a 10% capitalization rate. And then because nobody can buy the whole company at this point, I think, right? But what you can do is divide it by the number of shares outstanding, and then you get to a per share price. So you can see right here, it's 44 instead of their current price of $233. So it's obviously a lot lower. The difference is if you just look at the hard cold cash the business is generating, the market cap for this company, if you think that it should give you a 10 capitalization rate, is $151 billion. But current market cap for Tesla is actually, I think, 700 billion or so, right? I think you can see it from here. Yeah, 731 billion. Another way to say it is that it's overpriced. Okay, that's the whole point of this exercise. I like this method because it's very simple. If you understand the concept, right? How much ever cash is generated in the company, I'm only willing to pay 10 times that as an investor so that I can get my 10% capitalization rate. It's also very commonly used in real estate. All right, so then the next one is called the payback time. And the idea for this method is that public companies usually gives you a payback time of 16 years. What that means is that if you invest a certain amount of money in a business, you can get all your initial investment back in 16 years. But then because we as value investors, long-term investors, we almost prefer to buy companies that are private instead of public, because public businesses are so liquid, it's so easy to buy and sell. And that tends to give people a very short-term motivation to just trade. Long-term investors, they can leave the money in there. They don't have to be subject to the short-term emotions of the market. So because of that, we would look for a shorter payback period of time because we're willing to just let it sit there for a number of years. That's how the 8 years payback time came from. But the idea is also very similar to the 10 cap method. So you look at the cash that's generated from the business, but then you have to take into account some other cash activities. For Tesla, very interestingly, they have this investment in marketable and equity securities that generated a loss for them in 2022. I don't know if it's Dogecoin or something else, but that was also straight cash out of the business. Even though it's financial activities, which is usually below the operating income line, for our purposes, you still have to take that into account. We already included the maintenance capital, so I haven't seen any other significant capital expenditures from the 10K or Seeking Alpha for that matter. So the free cash flow is $9 billion for the business. And then the other assumption we need to use is the growth rate. This has been taken from Seeking Alpha as well. This is the forward-looking growth rate. Assume that the cash flow would keep growing at that rate. 23% is actually a pretty high rate. And it's a growing business, so let's say it's reasonable. The idea is that you keep growing the cash year over year until 8 years later, the business will be generating this amount of cash flow, 49 billion, in year 8. The accumulated cash over the 8-year time horizon is $213 billion. And then you divide that amount by the shares outstanding to get to the per share price. So the payback time method give you $61, which is again much lower price than the current stock price. Last but not least, the margin of safety method. So this one is also pretty straightforward. You have to assume the growth rate, which again comes from Seeking Alpha, the 23.07%. Just lose the percentage symbol. And then the PE ratio would be multiplied by 2. This is just a shortcut to say if a company grows at a certain rate, their PE ratio is 2 times that. The idea is that the higher the growth rate, the higher the PE ratio, right? Because you usually give a higher PE ratio to a growth company as opposed to a mature company. And then the historic highest PE ratio is insane. It's 1,120. It's not uncommon though for growing tech companies, I would say that, because I think Facebook, when I did that evaluation, it was even higher. But you take the lower of the two, and in this case, it's 46. And then the earnings per share, which we already calculated in the discounted cash flow model, that's $3.62. Then you would get to the future value of that earnings per share. The formula is shown here, but basically it means that if it grows at 23%, which is this growth rate that we have been using, in 10 years, what would be the earnings per share? Okay, so that gives you $28.86. Based on the PE ratio, which is 46, that would translate to a stock price of $1,331. And then you discount it back to the present value. And here we assumed 15%. And the reason why we use 15% is because you're going to do the last step, which is halving the price divided by 2. So that gives you $164. It's still a watch. It's not a buy yet with this method either. So to sum up, unless you are really willing to use very rosy projections and have such strong belief in this company, you will probably not buy at this point. Could it get to that price? Certainly. If it continues to grow at this latest return on equity ratio, yeah, of course. And then there's other promising businesses like their robot taxi business, and that's what ARK Investment has relied heavily upon. Right? That business is assumed to take over because there's no other competitor. And that could materialize, right, if everything is executed well. But at this point, not for me. Hopefully you find this video helpful. If you like this video, please don't forget to like and subscribe for more content like this. And feel free to comment. I would love to hear from you. All right, bye for now.